So, I had this little financial puzzle I wanted to solve. The goal was to figure out how to turn my monthly savings into actual physical gold. But, there was this one major hurdle that kept getting in the way. So this is basically me walking you through my personal playbook, how I solved it step by step. And it all started when I had to ask myself a really basic question.
Right? We're all surrounded by these one-click solutions, everything promising to be super convenient. But when I actually sat down and looked at my own numbers, I had this realization that for me, the easy path was actually costing me. It was like this slow, steady leak I knew I had to find and plug up.
So, what was my quest? When I boiled it all down, it was really simple. I just needed a disciplined system, a plan, to turn a chunk of my cash savings every month into real, hold-it-in-your-hand, physical gold.
I set a really clear target for myself. I was going to put away somewhere between 10 and 20,000 rupees every single month. And the whole point wasn't just to see numbers go up on a screen. It was about ending up with a tangible asset. But man, as soon as I set that goal, I hit a massive wall.
And there it is, the big one, the 30% tax bracket. Honestly, this changes the entire game. For me, the biggest cost of any investment isn't the fees or anything like that, it's the taxes. Every single rupee of growth gets a 30% haircut. That number, 30%, became the filter for every single decision I made after that.
Okay, so with that 30% number just burning in my mind, I started looking at all the obvious, easy ways to save. And pretty quickly, I realized that one by one, they were all basically financial traps, at least for my very specific situation.
The first stop for disciplined saving is usually a recurring deposit, an RD. It's safe, it's simple, it's what everyone tells you to do. But for my goal, it's an absolute non-starter. That 30% tax constraint just makes it completely inefficient.
I mean, this chart just lays out the problem perfectly. Any interest I make from an RD gets slammed with my full 30% tax rate. Now, compare that to the potential 12.5% tax on long-term gold gains. That is an 18% difference. That's a huge chunk of my earnings just gone, vanishing into taxes, all for the sake of simplicity. Yeah, no thanks. That's a trap I had to avoid.
All right, so RDs are out. What about the cool modern option? Digital gold. It's everywhere, it's super convenient, but that convenience comes at a shockingly high price. We're talking about a 7% loss right out of the gate. So before my money even has a chance to do anything, I'm already in a 7% hole. Think about it. There's a 3% GST on every single purchase, plus this buy-sell spread, which is just the difference between the buying and selling price, of another 3 to 5%. That means my investment has to grow by 7% just to break even. It feels like starting a race 10 yards behind the starting line. So, after ruling out all these traps, I finally found my solution. It wasn't the easiest or the one with the flashiest ads, but it was hands down the most efficient tool for my specific situation. The Gold Exchange Traded Fund, or ETF.
And that, of course, led me to another question. Well, why not just a gold mutual fund? They sound almost exactly the same, right? But as I started digging in, I found a few little details that made a huge difference for my plan.
Just look at this first row. With an ETF, my investment qualifies for that lower 12.5% long-term capital gains tax after just 12 months. But with a mutual fund, I'd have to wait a full 24 months. When you're fighting a 30% tax bracket, cutting that wait time in half is a massive win. And on top of that, a lot of these gold mutual funds are really just wrappers that hold the exact same ETFs and then charge you an extra fee for it. Why would I pay a middleman for that? So, for me, the decision became crystal clear. The gold ETF lets me, 1, get to that sweet lower tax rate twice as fast. 2, it lets me completely sidestep that 7% upfront loss you get with digital gold. And 3, I get to cut out the middleman and avoid those extra mutual fund fees. It's just the most direct, most efficient path to my goal. Simple as that.
Of course, picking the right tool is just half the battle. You still have to use it. So I mapped out a really straightforward plan for how I'm going to invest and, just as important, how I'm going to get out and finally get my hands on that physical gold.
The execution is super simple. First, I just need to pick an ETF that's easy to buy and sell. One with high liquidity, lots of trading going on. Second, I'll set up what's called a SIP, a systematic investment plan, to automatically put in 20,000 rupees every month. And third, I'll just use my existing brokerage account. No new apps, no extra paperwork, easy.
And just to make it real, these are the kinds of ETFs I'm talking about. They're well known, they're traded a lot, and they're run by big, reputable firms. Picking one of these just makes the whole process smooth and reliable, and it means I won't have any trouble when it's eventually time to sell.
And then there's the exit plan, which is just as critical. When I've saved up enough, first thing I'll do is double-check that the units I'm selling are more than 12 months old. That locks in that awesome 12.5% tax rate. Then I'll sell the units on the stock exchange. And finally, with the cash in my bank account, I can walk right into a jeweler and complete my original quest, buying the physical gold.
This is basically the note I've written to my future self. For any time I might think, oh, a simple RD would have been easier, I'll just remember this. The easy path would have cost me a huge chunk of my earnings in extra taxes. Plus, it wouldn't have protected my purchasing power if gold prices suddenly shot up. With the ETF, my investment's value moves right along with the price of gold. With an RD, it's just fixed.
So that's it. That's my whole game plan, from start to finish. It's totally tailored to my specific situation, my specific problem. And that kind of brings the question back to you, right? I figured out my biggest cost was taxes. What's yours? Is it fees? Is it convenience costs that are secretly eating away at your returns? Or maybe it's something totally different. Just thinking about that one question can change your entire strategy and probably help you find a much more efficient path to your own goals.